I've always viewed valuation more as you have to look out 3, 5, 7 years to ultimately think where you think the market's going.
Today's guest is one of the most influential tech analysts on the planet. Dan Ives is the managing director and head of technology research at Wedbush Securities. And for the last 25 years, he's been the person the world turns to when they need to understand what's really happening in tech.
I remember in late 2022 meeting with like a ton of engineers, just part of the work that we do, talking about AI and where everything's headed. They were late 22 yelling into an empty forest, right? But I was convinced like this was going to be the beginning in terms of everything Nvidia was doing of the AI revolution. Microsoft does the OpenAI investment for $10 billion. And I think we put a note out where like the AI revolution's begun. My whole view is like, it's not just about big tech. That was 23, 24. It's about who in software, who else in chip, the grid, infrastructure.
So you're one of the most well-known Wall Street analysts. You're famous for your calls on Microsoft, Nvidia, Palantir, and perhaps most notably being early on Tesla. Let's start there. So why are you bullish on Tesla today?
Well, I mean, today, it's because my view, along with Nvidia, it's two of the best physical AI disruptive players in the world. Look, I've never viewed Tesla going back, a decade as a car company. I always viewed everything Elon was doing was disruptive tech. And today, when I think about the AI revolution, I don't think there's a better play outside Nvidia. I'm thinking about the longer term AI vision, physical AI in terms of autonomous robotics, than Tesla. And that's why I think it's $2 trillion and ultimately a $3 trillion market cap.
Maybe a dumb question, but how is Tesla an AI play? Maybe you could unpack that.
Yeah, I mean, to me, when it comes to true AI technology, I don't believe there's a better use case than autonomous. So I continue, it's my view that Tesla will dominate the autonomous world. When I look out the next 3, 5, 7 years, robotics, I think is just the start, but I think no one can match their scale and scope. And I think when it comes to miles driven and ultimately really viewing Tesla as much more of an ecosystem, that's how I've always viewed it, 10 million cars out there. I don't think there's a better AI use case than when I think about what Tesla's going to do over the coming years. And look, and I just say the last decade, and I've covered tech, 25 years, there's no more emotional bull bear story than Tesla. And now it's about Musk proving it out.
You have kind of an art approach to your valuation as well as a science, and you kind of marry these better than almost anyone. How do you go about figuring out the intrinsic value of something like a Tesla? Is it a DCF analysis 10 years from now, or just walk me through kind of your methodology?
I've always said, right, like if you focus just on 1 year P/E or 1 year valuation, you miss every transformational tech stock the last 20 years. So there's no doubt, like I've always viewed valuation more as you have to look out 3, 5, 7 years to ultimately think where you think the market's going. So look, I mean, Tesla would be a good example. Like, it's my view that like 20% of automotive is going to be autonomous by the year 2030. So when you think about Tesla today, just forget deliveries quarter to quarter and what they're doing. I mean, I could argue that Tesla's revenue today will ultimately potentially be double when you look out over the next 6, 7 years relative to the opportunity. So when I look at EPS, can they do $12, $15, $20 of EPS power? Yeah. So I don't view it today as just a stock trading at XXX times next year earnings. It's my view, like, what is robotics going to be? What is autonomous going to be? Look, and Palantir has been a perfect example of that, right? Like, the haters hated it at 12, despise it at 50, yelling from the mountaintops at 100. And I always say, like, the bears, when they're in hibernation mode, and the Pinot Noirs, again, I like Pinot Noir, but they can't see AI in spreadsheets.
One of the thought experiments that you told me is that you think about kind of freezing time, almost like private equity. You make the investment in Tesla today, you wake up in 5 years, what is it worth? Do you take kind of a private equity lens to it, or how would you describe that?
Yeah, Dave, I think that's a great question. I think it's much more of that approach that I've always taken, even though like obviously a lot of investors, over time have disagreed with it, because it's my view. Like let's say a company like Palantir that's going from a government big data play transforming to a commercial AI play. I don't think you could look at that in the next 1-2 years. You have to say, okay, their secret sauce, what are they building out? What's this going to look like in the next 3, 5, 7 years? And that's always how I've looked at, especially disruptive technology plays. And given where we are, right? I mean, we're in the biggest disruption phase in the last 40, 50 years in terms of AI revolution. And it's my view, like, that's how you have to be able to look at these names.
And easier said than done to kind of have this mental benchmark in your head of 3 to 5 years. Very hard to kind of survive the turbulence. How do you deal with the turbulence and basically surviving the ups and downs of the public markets?
I could go back to like my 2 worst years in 25 years, '08 and 2022, right? In terms of like, you're just given the macro and then the rate environment. And I think it's very easy as an analyst to just throw in the white towel. It's easier to kind of go with the pack, not fight sometimes the trends. Stocks are selling off against you, but look, I've traveled 3 million air miles, 25 years. An advantage that we've had is that just being around the globe, you have such a sense in terms of like what things look like in Taiwan, what customers are talking about in the Midwest, what are the technologies emerging. So it's my thesis that I've always built on is that like I'm going to do the work, and even if stocks might not be reacting at that time favorably, or maybe even a quarter, right? Like we miss a quarter. Like the company didn't crush numbers, like maybe the stock, but our checks are telling us otherwise.
But if you think about the markets kind of gaslighting you, telling you that it's a bad stock, and then your customers are telling you something else. So you have kind of almost this counterbalancing constant feedback. You're counterbalancing the market sentiment with kind of on the ground feedback.
I'll give you like a really good example. Like I remember in late 2022, meeting with like a ton of engineers, just part of the work that we do, talking about AI and where everything's headed. I'm thinking about late 22, yelling into an empty forest, right? But I was convinced like this was going to be the beginning in terms of everything Nvidia was doing of the AI revolution. Microsoft does the OpenAI investment for $10 billion. Everyone's like, why would they do this? Is great. At that moment, we're like, and I think we put a note out, we're like, the AI revolution's begun. Then the emails that I got from institutional, let's just say I wouldn't repeat them here. What are you talking about? Create this. But that's a good example. Like because I felt like the work that we did gave us confidence that we basically put us, almost like, a stamp or sort of pole on the ground saying like, this is it. Things have changed.
I think of mimetic and herd behavior, and I think of it as like different herds. There's like a Silicon Valley herd where certain things are accepted, certain things are paradoxical. There's like a public markets herd. And for example, like the public markets are much more later adopters, right? It's just a different, so saying something when you're with your Silicon Valley friends could sound very different, could get you more isolated than with your public friends.
Yeah, and then also I'd say like it's also the role that retail has played in this market. I think the way a lot of people on the institutional side have like missed, I think a lot of these stocks is that they've been caught up in their echo chambers from New York to San Fran to Connecticut, and they've missed some of the underlying trends that are happening in names. And whether it's Robinhood or Palantir, some of the Nvidia moves or whatever, I think it's a good example where you have to have a good understanding of sentiment, whether it's Singapore, or meetings in Florida. And also it's the work that we do in the field. I remember Palantir was selling off like massive after a quarter. Maybe I'm just from like $30 to like 23. I'm just giving an example. We're selling about around that. Everyone's like, that's it. Stories over. I went from 12 to 30. This is it. But yet, like the work that we were doing at boot camps from Palantir with customers, it was unlike anything I've seen, relative to the demand. So that was a moment where everyone's like, is this it? People are downgrading the stock. You're like, no, we might have like missed the quarter from a timing perspective. This is a table pounder moment.
When we last chatted, you said that your alpha are things that are not in the spreadsheets, which is very surprising for public companies. What exactly is not in the spreadsheets?
So let's say I'm talking to a customer, and a year ago they thought AI was hype. They weren't allocating budget. It's a CIO. And today, after doing a bunch of demos, that customer is like all in, and now maybe it's a 1 or 2 priority in their budget. That's one but that's important data. Like that's showing what's happening in the technology. So like if MongoDB misses a quarter and the stock's a disaster, but I'm hearing from customers and I'm in the work that we're doing at user conferences, we'll realize that they have a unique mousetrap. Well, why would that not be just the opportunity rather than throwing the towel? And I'm just saying, like, I think as an analyst on the sell side, it's easier to just stay with the herd. Don't go against the grain. I've never dressed like that. I've never analyzed stocks like that. And I think that's been part of our framework, right? Like part of our DNA. And also, like, I've learned like the most from our failures too. Like maybe like there have been stocks like over time, like we were too early and then maybe lacked the confidence. But yet at that time, that was a huge momentous move opportunity. And I think I learned a lot of that, like being so bullish and like what's like when Nadella came to Microsoft. If you go back at the time, everyone's like, oh my, they should have gotten like an outsider, like Michael Dell. I'm just giving examples like, Chambers, whoever it was. And Della, I always viewed as the Yoda. Like he understood the term cloud better than anyone. But if you go back when he took over at 14, it was like, okay, like it didn't at first hit. And there were maybe moments in there where we're like, okay, we're fully confident in our vision, but maybe we're not going to pound the table. And that actually was the time to pound the table.
You mentioned kind of how you dress and being outside of the herd. Is the dress a way for you to separate from the herd? Or since you're separated from the herd, you dress differently? What is driving what?
It's kind of like I've always dressed funky, so that's always like been there. But I do think like it's like a little symbolism too, like, cause I'm not gonna like go to the beat of like a typical drum. Like I'll dress different. I could care what others think, but it's just like the way that I call stocks. Investors that have like followed me for, decades understand they understand the way that we analyze, like just like our ETF, right? Like they understand like how we pick stocks, why we pick stocks, and some could disagree, but I think over the years, like we've proven out our success.
I had Mike Maples, famous venture capitalist, and one of the things he really focuses on, especially early on, is kind of finding your true believers and finding your early believers and not focusing on the people that don't believe in you. How do you operationalize? You seem to have operationalized this really good. How do you avoid the noise? How do you avoid conformity? And how do you find your early adopters? I guess it's 2 different questions.
Yeah, I mean, like, look, it's like I found that, like, definitely on the institutional side, right? Like, there's a lot of people that believed in me early, like, that were very influential, on the institutional side. And that in those early days gave me like a lot of confidence. And then I think ultimately I started to realize like haters hate, and to some extent understand the opposite side, like understand the bear argument. Like that's something like it's very important to me to engage in the opposite side to understand the differing view, because actually it's helped me a lot. And I think obviously like with social and retail, it's one where it's kind of like I'm an open book. People love it, people hate it. But the way that we do things has been very clear in terms of our view of stocks, in terms of staying long and strong, in terms of our view of like just this, basically 20-year tech bull market, my view of AI. So I just don't get caught up in like noise, because it's also a confidence in like the work that we do.
How do you know when you're wrong?
You know when you're wrong more from when the thesis changes, like when all of a sudden, like let's say, like I'll give you an example. It's like Adobe, like as being very bullish on Adobe over the, like I was a believer that Adobe was going to be able to like pivot, and AI was actually going to be like a talent for him. And then basically like after like 6-9 months, a year, started to realize more and more from like customers and partners, like that wasn't right. Like it was actually the opposite. Like AI was going from like a tailwind to actually like a headwind. So that's a good example of recognizing like we were wrong, maybe right, obviously on the call, but on the AI piece wrong, admitting we are wrong, and then ultimately taken out of our like our core AI index.
Essentially, a customer says something that breaks your frame of mind, and then you start to build consensus on the bear case. You start to double click on the bear case.
And also it's like not being, I think it's easy too where like, let's say like if you have like a kid and your kid does something wrong, it's easy as a parent to be like, oh, it's not my kid, it's the other kid, it's the parent, it's the coach. Sometimes you have to be like, okay, like, yeah, like it's my kid. Like you got the ownership. And I think it's very easy with stocks. You can kind of like not listen to things that maybe go against your thesis and rationalize them. And I think that's the other thing. I've gotten like a lot better over the years to understanding like that input and being like, hey, I gotta like, this could be a red flag. Let me do more digging. Like I think Oracle is an example, like about like 2 years ago, like stocks going to like a really rough spot. And like I spent like 2 days basically just like at user conferences, talking to customers. It was one just to like solidify that my broader thesis, was right at the foundation, even though the execution could be off from a timing perspective.
I like the Andreessen Horowitz, strong convictions loosely held. So it's this idea of having very strongly rooted theories, but being willing to very quickly change it. And sometimes it just, things change. A new CEO comes in, they change their strategy. It's not that you were quote unquote wrong. You were right at the time, but the thesis has changed.
Stocks don't lie. Sometimes it's like, okay, like stocks telling you something. What is it telling you? And it's like, look, and I'll be the first one to say, like, if there was like a, like almost kind of like a great way to like sort of simplify like our career, it would be like great at picking this inflection point, great at riding it, but probably like our fault is like not calling the top, right? Like it was like staying on too long. And I think that was maybe like the thesis, like, there's many times on names where like we've kind of gone like this, stay on, okay, then eventually like, you're right, but like it's hard when you're like on this part where it's almost like you're like, okay, I should have, like I should have gotten more cautious. And I think that's something where it's always hard to see that inflection. And that's something that like we probably we spend like a lot more time trying to find that to make sure that we're not missing something and staying on stores too long.
You've been doing this for decades. Have you ever had a situation where the company became more profitable, more intrinsically valuable, and the market just never caught up to it?
Yeah, I mean, I think there are like a lot of it, but I think a lot of those examples were companies that ultimately ended up getting acquired by like private equity, like like SailPoint or like
They may not have intrinsic value in public markets, but they still have intrinsic value.
most of those examples were companies like they got bought, and it was almost like the public market never recognized it, whether it was like the management team or the consistent execution or whatever. And then a lot of those companies ended up like getting acquired, either private equity or strategic. I think that's usually how that's played out. Now, like there have been some like I think Oracle is a good example where like that was happening, I feel like a year ago, but it took the market time to catch up. Like Oracle would be a good example where those dynamics were happening a year ago, 9 months ago, but only in this last 6 months is it truly caught up. Like another good example, let's say be like Google. Like, look, I'm of you like anytime someone says like this lawsuit, this antitrust, this breakup, I'll always take like if we were betting, I'll always take like the over. Like I always bet like this is gonna be a lot better than the fear. So Google is a good example. I was like, search, it's gonna kill, like AI done with search. The DOJ, it's gonna get broken up. Like New York City cab drivers bearish in the stock. But that was an example. Like I see what's happening in terms of like Google Cloud. I see everything Kurian's doing. I see salespeople going from company X and Y. So that was one where it was like, dang, okay, we're not right. Stock's telling you something. Like Salesforce, investors, like, you're wrong. And it happens, right?
There's a famous John Maynard Keynes quote, markets can remain irrational longer than you can remain solvent. And for somebody trying to operationalize being bullish on a single stock, what would your advice be to him or her in terms of the sizing? Because if you do size it too much, it becomes difficult to execute. So any guidance on sizing and how do you build a portfolio of these positions?
Yeah, I feel like it's almost like, let's say if conviction level is scale 110. And let's say by definition, if you're bullish, you're always going to be a conviction level like 8 to 10. When you're like an 8.5, you're scaling, it's still like toe in the water. But when it inflects from like an 8.5 to like in the 9s, that's where you scale up. Like it's almost like, because I do think you're exactly right. Like it's easy where you can be like right, but your timing was wrong, and that in $3 gets your coffee. So it's almost like trying to figure out like when it inflects, and just that's like those are the moments to me where like the conviction level. I think that's where you
and the conviction inflects, not the stock.
Exactly, almost separate from the stock. It's like
you're not trying to, and you're not saying that you could pick inflection points in the stock. You're saying you know how to position yourself so that when there's a, I guess, catalytic.
That's exactly. And now you might be like, when that happens at first, like the stock might go the wrong way. But I'm fine with it because like you have conviction now. That conviction could be from like like you're seeing more companies go for like the stack that the software company is selling, or people are lining up for chip demand that maybe hasn't been reflected so much in numbers. Like that would be a good example of Nvidia in like late 22 or early 23. Sometimes it's very easy, like the stock could go against you based on like macro, whatever it may be. But if your work tells you, that's where it's like, and look, and you're betting on yourself at the end of the day.
You travel the world, you talk to many of the buyers. Are you ever having the buyers actually point you to a new stock that you might have never heard of?
All the time. Like, it would be like, there's been a lot of companies where maybe like they weren't even on my radar, but they're coming up like in bake-offs. And I'm like, what? They're coming, like, yeah. Oh, like there's an example, let's say like Innodata, small cap, best software company in New Jersey. It's like stocks like no one cares. But then all of a sudden, like in a lot of these AI, I'm hearing about them a lot. Like in a lot of these AI deployments, no one cared about, and that was a good example. Like, we started covering the stock, and that's been one of our core, probably one of our best calls over the last 6 months. I think that's also where like talking to so many people, whether it's investors, customers, partners, and traveling a lot, I think that helps you. It's very easy to like be in your own like echo chamber. And I think that's sometimes like, I think that could be like a big negative.
There's this weird psychological phenomenon where you learn something and blows your mind, and then your brain convinces you that now you know everything about the topic. So you're just constantly getting updates to your brain in ways that are very kind of non-linear, and then you still think that now you know everything. So there's this bias that human beings have that they know everything.
You don't know what you don't know. Like, I always view myself as like, I never have like hubris. Like, I'm always trying to like learn, right? So it's like, to me, that is, I think that's one of the keys too. And it's just trying to like learn about different things that maybe, would just increase your ability to better understand the markets one way or another.
Last time we chatted, you said that you make yourself a conduit of information. What does that mean?
As a conduit of information, we view ourselves as almost like very intertwined globally with investor feedback. And I think that's a big part of our value, right? Like when I'm marketing, no matter where it is, investors like, what's the sentiment on stock X? Why? Do you think a lot of people are bullish into year end? What about valuation? What are people talking about? And I think conduit of information is like it's a big role you play as an analyst.
I kind of look at it as information bartering. We have conversations every day, 3 to 4 LPs, GPs. They're telling us information all the time. We're telling them market information. And it's kind of like this positive sum. As long as you have information to give, and as long as you're giving kind of at the margin more, people will start feeding you information. Now you have more information to give to the market.
And also part of it is like that. And also like I'm very active in social, right? Like in other words, like in terms of like social media, speak at a lot of conferences. Like like just by traveling, I feel like you have a lot, you're meeting like new people all the time, different perspectives. And I think like that's helped us.
Mark Andreessen recently said that the top public investors that he knows look at public stocks as having power law type aspects. So power law is when you have a portfolio of 10, one of them returns more than everybody combined to an order of magnitude. That was a little surprising to me. But if you look at Amazon's returns since IPOs and the thousands of X's and Google, Microsoft, are there still power law returns in the public markets today, or was this kind of a thing of the 90s and 2000s?
More today because of what's happened with the AI revolution. And I think how a lot of investors are maybe not even seeing the second, third, fourth derivatives that are happening. I mean, that's a whole part of like our ETF. Like my whole view is like, it's not just about big tech. That was 23, 24. It's about who in software, who else in chips, the grid, infrastructure. And a lot of times, like, I'm looking for names being like, okay, could this stock outperform? And then there's the rare names where you're like, okay, like, no one cares about this. And I think this thing could be a 4-bagger, a 5-bagger. Like, I feel like sometimes when you feel like you uncover some of those. And what I love is like when sentiment is like so negative and you feel like, you feel like you've like stumbled onto something.
It's quite common, especially among smart people, to think of second order effects. So you now need AI, so now you need to build these data centers. Few investors actually think of third order effects, and kind of even just, it's only two derivations out, but for whatever reason, investors don't think about that, or it's not commonplace.
But it's even like G Vernova, like as like a power play, okay? Like that's in our like Ives AI 30. Like Nemesis, which is an infrastructure play, there. Like Aqua, which is a nuclear play, there. But David, this is the example, like, okay, it's like, I'm not talking about, like, we're talking about football, not the cookie cutter first 15 scripted plays. What are those like moonshot plays? And it's trying to sometimes see where the market is going that maybe at the time investors don't see. Like maybe even like if we're in a market now, everyone's like, Nvidia, OpenAI, like is this a bubble? Like does this remind you of things, like froth, like maybe risk off in the near term, whatever? See, I view it differently. For me, it's like if somebody covered tech stocks in the 90s, I compare it dramatically different relative to the use cases, the spending, and everything I see. And I view times like when there's like sell-offs as maybe just times to just further my conviction in tech names that I think are mispriced. My reputation's been built not when stocks go from here to here. Dude, like in that, my Shih Tzu or Terrier could be the genius. It's when stocks are going like this and everyone's jumping ship and you're like, these are the opportunities.
Do you judge yourself kind of as a venture capitalist would based on your big outliers, or are you kind of looking at your hit rate?
It's a combo. It's my hit rate, but also a lot of times it's like my outliers, like my moonshots, like was I right? Like, and I take it very personally in terms of like what I'm doing. Like when I'm at an airport and some random person comes up to me and they're like, thank you so much, because of you I invest in this. Or if I'm in Europe and someone's like, my grandpa invests in it. See, I view it much more like personally. This is not like client and just numbers and whatever money you make, whatever. I take it much more personally because people are putting their confidence in me. And I take that as a very heavy weight beyond just like a job.
Why is investing in the public markets like batting 300 in baseball?
It's hard to outperform. The alpha and the information flow is so hard to find things on the edges. So when you think about like batting 300, and ultimately if you bat 300 over a career with some other stature in Cooperstown, because I think it's about information flow. Like I think it's just like harder and harder to distinguish, differentiate, and also the timing of things, especially in a market that's become so global, right? Like, I mean, today, if I think about today already, I've talked to investors from Korea, Middle East, New York, California, South America.
One of the keys to your success is you believe you could push buttons on a stock, and you said that you could push buttons on Tesla. What does that mean? How does that help you generate returns?
Tesla is one where I feel like when you have a big following on a name, I feel like you can help change narrative. And I think Tesla is one where like it's very important to like make sure like the narrative is right. Because I think as an investor, it's very easy. Just as an example, like if you look at the last year, so let's just say like you looked at Tesla's numbers. So all you know is just their quarter, what they report, and what street numbers have done. You'd right now think Tesla stock's $200, but instead it's whatever, 430. Because it's about the narrative. It's about the focus on Tesla is about the future, about autonomous, robotics, and really then become much more of an AI play over the coming years. We view ourselves as very important in a lot of these names in terms of like to measure the narratives right, because I believe that's where the growth is. And I think it's very easy where a lot of names become very combative. You have a thesis and you have a mouthpiece and you have to be clear about that. I mean, look at Palantir as an example, right? Like the last $180 or whatever, $170 of the stock move, people have just fought it every time. Valuation, whatever, maybe like it's a services company, and that's created the opportunity.
When you say push buttons, you're able to contribute to the public discussion on the stock. You're able to influence the board. What do you mean exactly?
Yeah, like let's say like from a board perspective, like I felt like the board needed to get a new pay package to Musk. I think there was also a groundswell among a lot of investors I was talking about. So we put out basically like a 3-point note to the board what they need to do with Musk. Now, again, like I think that message was well received. The board ended up, a month ago doing that stuff. But that was a good example. Like that was an overnight in the stock. Like Musk needs to be with Tesla. He needs a new package. He needs to get 25% ownership. Investors want more XAI and they want that ownership. So also it's like, it's playing a role in that way. Like it's trying to like lay out what ultimately I believe is important, not for me, but for the story.
You mentioned Palantir. I was invested 5 years before it went public. I had to sell via lockup because of our provisions, but you were right on Palantir. And specifically, I just want to go back because oftentimes people change the narrative in retrospect.
Oh, yeah, I know. It's a narrative. Yeah.
At the time, everyone was saying it's not great because it's consulting, it's masquerading around as a tech company. What did you see that other people didn't see?
Well, first of all, and I started off like massive AI, whatever, it was like $12 or $15, $13. Well, first of all, it was my view of CARP. Like, I'm also a believer, whether it's Sal or MicroStrategy or Strategy or Nadell at Microsoft or CARP, like, I think you're betting on the leaders. Like, you're betting on Jensen and Nvidia. So I'm a huge fan, huge believer in everything CARP is doing.
Is that also not in the spreadsheets? The leadership is essential. There's no line item, right?
It's like AMD. Like, let's take this past year. AMD, it's a disaster. Dude, Lisa Su, if she's flying an airplane, I'm in 3A drinking a cab, feeling really good. So then there's other managing teams that I would sprint like Usain Bolt away from that stock. They're so bad. So I do think that's something that you have to have a very good sense for, like, which management teams to bet on. Proof point, okay? Like Gary Steele. I remember, like, when I met Gary Steele, proof point, I'm like, this guy's Hall of Famer. Like, he might be the best CEO of a small cap manager I've ever seen. Proof point ended up becoming like a 40 bag or whatever, but it was betting on Gary Steele, and now he's at Splunk. I do think that that's important.
One of the most mispriced things in the public markets is founder-led companies. Yeah. Because there's this 3-month quarterly reporting. Now they're trying to change that to every 6 months, but this disconnect between playing for a quarter and playing for eternity or for however long the founder's alive, it seems like it's not priced in. Is there any credence to this?
Yeah. And also, I think founder-led, like CEO, there's all differing views, right? Like sometimes, like, you need maybe other management to come in and they can go to chairman or whatever because they could actually lead it. Other times, they're the ones to actually lead the vision. I always think sometimes like companies get to a certain scale, especially a lot of times like when companies go from like 500 million to a billion, in software, that's like a huge whip. And there's a lot of management teams where like, okay, you know what, they were great to get them to there. Now it's like it's time to hand over the reins, right? So, but that's why to like not in the spreadsheets. Like I think that is something. Like I think in this job, having like EQ is as or more important than IQ. I don't know how much it's innate, you're born with it or taught, but sometimes it's like sitting down with individuals being like, is this someone I want to bet on or not? And I do think like some of like the best investors, they have just their genius level EQ.
Said another way, the IQ is in the spreadsheet, or the numbers are there. The EQ is almost inherently not in the spreadsheet.
That's like a really, really important thing that I think gets like overlooked very often.
People will fact check me, but I believe the first time that there were super voting shares in this founder class was Google when it went public, now Alphabet.
I think you're right.
Mark Zuckerberg has since done that. Obviously, Elon has a lot of control. Do you think net that's a good thing? And how is this kind of 20-year experiment played out?
I actually think it's a great thing for those companies. Like, in other words, like I could say Sailor's done very similar things in MicroStrategy. Like, yeah, that's another, because look, it's like you're betting on that pilot to fly the plane. If you get too caught up, investor boards, rep quarter, make some missteps, so I do think like in order to have like a wartime CEO, like a Zuck or a Musk or a Sauer, I do think you need that, because I think it's very easy to get caught up in gyration. Boards and other investors.
It's like an insurance against an activist short-term takeover. So said another way, and it's not only that activists can't come in, it's that the team knows that activists can't come in, so therefore they could plan for the long term.
I think that's right. And I think like if you look like what Zuck's done with Meta, go back to like Metaverse, that disaster quarter in October, stocks $85, whatever. It's like, it would have been very easy to like, should we change course? And then what is he? It's like, bam, change course, and the rest is history.
It's very easy to criticize Zuck, but he has been managing Facebook truly and Meta truly like a startup. What does that mean? Taking large, big bets in every cycle, knowing that maybe 50% or maybe even 1/3 of them will play out. But if similar to the recent bet on AI, if that winner is going to be kind of a power loss. So he's like investing $100 or $200 billion almost on a venture-like bet, which is extremely bold, and I think rationally is the right thing to do, even though the first couple times you'll be wrong and everybody will ridicule you, and then on the third you'll be a genius.
Exactly. But then if you don't have that structure, it's hard to do that.
If you could go back to 1996 when Dan Ives graduated Penn State, what would be one piece of timeless advice you would give yourself to either accelerate your career or avoid some of those mistakes?
There were a lot of times earlier in my career where like, whether it was like, not getting jobs or maybe even at jobs, like, different failures, where it was very easy to like let that get you down and you get caught up in it. The thing that I would tell like myself back then would be embrace the failures, let them make you better, and it's belief in yourself. Like, it's just like all the success that you've had, right? Like, I'm sure like if you went back like 20 years and showed what you're doing now, you're like, whoa. But part of it is that like it's a learned behavior. And I think for me, it's like once like the bell went off, or be like, look, stop like getting focused on like failures you've had and let them get you down. Because it's a true story. I'm at FBR, and Freedom Billings Ramsey, that was a core part of my career. I remember I initiated on 3 companies, and I'm so excited, maybe it's 2002 or something like that. And 3 companies, in the next 3 weeks, they all go down 50%. And they were all buy rated. And I remember I'm sitting there stuck in Pittsburgh airport on a Friday night. And I'm thinking what am I going to do for my next career? Because disaster blowups. My head of sales at the time, John Billings, calls me and he's like, you're going to let this conviction just go. Who cares if the stocks were, and they all pre-announced negative. So you have conviction. That's what makes you. And it was like a Vince Lombardi type speech. That weekend, I wrote this crazy piece. This is temporary. These companies get bought. It's just confidence in the thesis. And actually, over the next, I think 9 months, all those companies got bought and they became all of them were 4 or 5 baggers. But that was a defining moment in my career where it's just stop feeling sorry for yourself if you're wrong and just have conviction in yourself.
It's not just the failures, it's having people around you that interpret the failures in a certain way. But the Zucker example is actually a pretty interesting one because he essentially tarnished his reputation for 5-6 years, even though he had made the right probabilistic bet in order to do what's right for Meta. And if he had been around people that were very herd-like or insecure, they may have said, well, you've made these 2 wrong bets, don't do the third one. But who you're surrounded with is as important as your own mental state.
And for me, just being on Wall Street 25 years, there's thousands and thousands of analysts. They just they disappear like the wind or whatever, right? So it's I've been lucky that I at FBR and then at Wedbush, that I always worked at places where they understood who I was and they gave me that time for the calls to play out. But maybe if I was at different firms that they didn't understand this funky dresser and they just the looks at stocks differently or whatever, then maybe it never would have worked, right?
Is there something in your childhood or background that allows you to be kind of out of the herd and eccentric?
Part of it is my dad always said people are always going to be better looking, wealthier, and smarter. Just accept it. There were certain things growing up in Long Island in the 80s, right? It was just I think that was a great place to grow up and just living in my household. It was one where it was just be your own self. So I think that was a big thing where it rooted back to those days.
What would you like the audience to know about you, Wedbush, or anything else you'd like to share?
Wedbush, obviously, doing great things from a tech perspective in terms of AI. We have our Ives ETF, which is we've been super excited about launch in June. Options and really good because that gives investors the opportunity to basically bet on AI. And then, very similar to the theme, we recently became chairman of Orbs, ACO, which is a company that's really focused on Sam Altman's world. I think Sam's going to be a great partner in everything he's done. I think there's going to be a single sign-on for the AI future. I think authentication is going to be more and more important in terms of human proof. And look, for people to know me, I do a lot of different things. The clothing line may be a little different, but it's all centered around the AI revolution. It's my passion for where that's heading.
A mutual friend told me to ask you about Snow Milk and your clothing. Tell me about that.
So, Snow Milk, an awesome designer in Williamsburg, in Brooklyn. They came to me and wanted to do a collab. So we did a Dan Ives collab at danivesclothing.com. And look, this is something where I have so many people, and these are for men, women, for whoever, different colors, funky designs. We start off with shirts. We're going to go into sweatshirts and hats. And it's been great working with them, and the demand's been really, it's been, obviously a lot. higher than I ever thought.
Well, Dan, you're truly a one of one. I've never met anybody like you, and I'm so lucky to have spent time and looking forward to continuing this conversation.
No, and I'm just happy that you invited me and all the success that you've had, and it's just great to be on here.
Thank you, Dan. Thanks for tuning into that conversation. If you love that conversation, you're going to love the episode right here.